Welcome to the Pro Ticker Deep Dive.
It's good to be here.
It is Wednesday, February 18th, 2026. And I have to be honest with you, if you are looking at your portfolio today, or if you've been doom scrolling through X this morning, you probably feel like you've been punched in the gut.
It is ugly out there. There is absolutely no sugarcoating the price action we've seen over the last, 2 weeks now?
Ugly is being polite. I think we're looking at a situation that I can only describe as a total psychotic break in the market, a complete fracture of reality.
That's a strong way to put it, but I don't think you're wrong.
Because I've got two stacks of research in front of me right now, and they are describing two completely different worlds. It's night and day.
You've got the retail reality on one side, which is, panic and despair. And then you've got the institutional reality, which is just quiet, aggressive accumulation.
Exactly. On one hand, I'm looking at the retail sentiment. It's a disaster zone. People are capitulating. The February curse, which we definitely need to talk about, is in full effect.
Oh, absolutely. It's like clockwork.
The chart's like broken. If you just looked at your phone, if you just looked at the ticker, you'd think XRP was going to zero and the project was dead in the water.
That's the emotional reaction, right?
Yeah.
That is the noise generated by the red candles on the screen.
But then, and this is the crazy part, I look at the second stack of papers, the flow data, the on-chain analytics, the institutional buy orders.
And it tells a very, very different story.
It tells me that while the average guy is panic selling at the bottom because he's tired of the volatility, the giants, the ETF managers, the pension funds, the endowments, they are buying at a pace we have literally never seen before.
We are in the middle of a whale war. That is the only way to describe it. It's a massive, massive transfer of wealth from the impatient to the calculated.
Yeah.
From weak hands to, diamond hands, I guess.
So that is our mission today. That's the deep dive. We are going to dig into this paradox. We need to figure out, is this a bull trap designed to crush the last bit of hope before the whole thing rolls over?
Or is it the opposite?
Or is this the greatest bear trap in history, hiding a generational buying opportunity behind a thick smokescreen of fear, uncertainty, and doubt?
And to answer that, we have to look at the plumbing. We can't just look at the price ticker. That's a lagging indicator.
Right.
We have to look at the Clarity Act stalling in the Senate. We have to understand this liquidity lock that's happening in the ETFs. And we have to figure out why a massive conservative insurance giant like Aviva is suddenly playing in the crypto sandbox.
Okay, let's start with the pain. Because we can't ignore it, and I think a lot of people listening right now are feeling it. XRP is hovering around, what, $1.45 to $1.50 today?
Yeah, in that range. It's trying to find a floor.
We dipped as low as $1.11 earlier this month. Compare that to January, just last month.
January was euphoria. It really was. We hit $2.40. We thought the breakout was finally here. The New Year rally was on.
And then the calendar flipped to February, and it was like a trap door open. The floor just fell out. So is this just bad luck? Is it random? Or is the February curse a real statistical anomaly?
It's not just bad luck.
Because I keep hearing people say, oh, it's just February. What did you expect? But that feels like a cop-out, you know?
It feels like a cop-out, but it's not. In finance, if you have enough data points, a superstition, it becomes a statistic. And the February curse for XRP is statistically significant.
Yep.
I mean, we've seen monthly losses in 7 of the last 11 Februaries.
7 out of 11. So it's not a 50-50 coin flip. It's a clear trend.
It's a clear negative bias for the month.
Why, though? I mean, is there a structural reason for this? Does the market just hate Valentine's Day? What's going on?
It's usually a hangover effect. It's like a party, right? January often sees what we call the New Year allocation rally.
Right.
Portfolio managers, they get new mandates, they rebalance the start of the year, fresh capital flows in.
So everyone's optimistic, putting money to work.
Exactly. Prices pump, retail gets excited and chases that green candle. By the time February rolls around, that initial wave of capital dries up, volume drops, and the market naturally cools off. It needs to consolidate.
Okay, that makes sense. So it's post-rally exhaustion.
That's part of it. The other major factor, especially for XRP, is Asia. You often have the Lunar New Year liquidity drain in Asian markets right around this time.
And Asia is huge for Ripple. That's their bread and butter.
Massive. Japan and Korea are two of the biggest ODL corridors for XRP volume. When those markets go on holiday or when traders withdraw liquidity for the New Year celebrations, you lose a significant support pillar for the price.
So you're getting hit from two sides. Western markets are tired after the January pump.
And Eastern markets are taking money off the table for the holidays.
You combine the post-January exhaustion with lower liquidity from Asia, and you get a pullback.
And this year, it was a brutal one.
Okay, so we have a seasonal depression, and this year it hit hard We dropped from that massive peak back in July 2025 of $3.65 all the way down to $1.11. That is a 60% haircut.
60%.
I don't care who you are, that hurts. That shakes your conviction. It makes you question everything.
It hurts enough to break people. And we are seeing that breakage in the sentiment analysis. It's crystal clear. The Crypto Fear and Greed Index for XRP specifically is at 24.
24. That's not just fear. That's extreme fear.
That's the territory where people are just dumping their bags to make the pain stop.
I saw the social volume metrics, too, from a couple of analytics firms. Bearish commentary is up 20 to 30% more than usual. And it's not just, I'm worried.
No, the tone has shifted.
It's, I'm done, I'm selling, I hate this coin. It feels personal for people now. There's a real anger there.
That is the capitulation phase. This is the classic disbelief phase that you often see near a market cycle bottom. Retail traders are they're fatigued.
I get it. They held through the lawsuit. They held through the long bear market. They got a little taste of glory at $2.40, and now they are right back at $1.50.
So they're throwing in the towel. They're saying, I can't do this anymore.
But here is where the story gets weird. Here's the plot twist. While retail is screaming, sell, on every social media platform,
The ETFs, the actual regulated, boring Wall Street investment vehicles, are quietly screaming, buy.
this is the divergence that matters. This is
Yeah.
the signal in the noise. Let's look at the ETF market. Since the U.S. spot XRP ETFs launched in mid-November 2025, they have amassed over $1.37 billion in assets.
$1.37 billion. And that's in, what, 3 months?
It's a few months. That's solid. That's a successful launch by any metric.
It's very solid.
Yeah.
But you know what? The total dollar amount isn't the headline. It's not the most important part of this story.
No, it's the consistency.
It's the relentless day after day consistency.
You mentioned a streak in the notes you sent over that. It blew my mind. I had to read it twice.
43. 43 consecutive trading days of positive net inflows.
Hold on. Let me just clarify that for everyone listening because that sounds impossible. It sounds like a typo.
It's not.
You were saying that for 43 days straight, while the price was crashing from $2.40 down to $1.11, while Twitter was melting down,
Right.
while people were calling XRP a scam again,
Yeah.
there wasn't a single day where more money left the ETFs than entered them. Not one.
0 net outflow days. Not one. Think about the psychology of that. In a normal market, in any other asset, when the price is plummeting like that, ETF investors panic. They redeem their shares. They flee.
Oh, absolutely. Look at Bitcoin. Bitcoin is the king, and it's been bleeding assets from its ETFs.
Exactly. In December alone, the Bitcoin ETFs bled over $1 billion. BlackRock's IBIT lost $250 million in a single afternoon session.
Ethereum ETFs have been bleeding too. The sentiment was risk-off across the board for crypto.
But XRP, different story. Every single day, someone or a group of someones showed up with a checkbook and bought more, day in, day out.
Who are they? Who buys an asset that is crashing every single day for 43 days straight? That's not normal human behavior.
It's not Dave from accounting who's day trading on his lunch break, that's for sure.
Yeah.
This is institutional allocation. This is methodical.
So you're talking about model portfolios.
Pension funds, endowments, family offices, they have a mandate to allocate, say, 0.5% or 1% of their massive portfolios to digital commodities. They don't care if the price is $1.80 or $1.40 today.
In fact, they probably prefer $1.40.
Of course they do. They are value buyers. They're looking at a 5 to 10 year time horizon. For them, this isn't a trade, it's an allocation.
They are buying the discount that the retail panic is creating for them.
Precisely. And this brings us to this critical concept of the liquidity lock. I love this term, but we need to break it down because it explains why this buying is so significant for the future price. It's not just normal buying.
Okay, let's do it. What is physically happening to the XRP tokens when an ETF buys them?
Okay, so imagine the entire circulating supply of XRP is a giant swimming pool.
Got it.
Every time you buy on an exchange like Coinbase or Binance, you're basically scooping some water out of that pool. When you sell, you pour it back in. Usually the water level stays somewhat stable because buyers and sellers are matched up.
Right. It circulates. That's why they call it the circulating supply.
But an ETF is different. It's a whole different animal. When an ETF manager like Fidelity or BlackRock creates new shares for an investor, their custodian, someone like Coinbase Prime, has to go out into the open market, buy the actual XRP tokens, and then move them into a cold storage vault, a deep freeze wallet that is offline. That vault is like a sealed tank next to the swimming pool.
So the water is taken out of the pool.
And it is locked away. It is no longer available for trading. It doesn't circulate. It's been removed from the public float.
So the pool is draining.
It's draining fast. The math shows they were removing about 1% of the entire circulating supply every single month.
1% a month. That's a huge number over time.
It's massive. And we are seeing the effects. Exchange reserves, the actual tokens available for you or me to buy on an exchange, have hit 7-year lows. We are down to around 1.6 billion tokens sitting on all exchanges combined.
That is incredibly low for an asset this big.
It is. So, to recap, the available supply is shrinking because of this liquidity lock. The institutional demand is constant and unflinching 43 days of buying.
But the price is down. That is the paradox.
It's a temporary paradox, right? The laws of supply and demand, they're like physics. They have to kick in eventually.
They have to.
Eventually, yes. Right now, the price is being suppressed by that retail capitulation we talked about. There is just enough selling volume from angry, fatigued holders to meet that institutional demand and keep the price down. But what happens once that retail selling dries up?
Once everyone who wants to sell has sold,
Yeah.
then the institutions are the only ones left at the table.
Yeah.
And they aren't selling.
Exactly. And that is when you get a supply shock, a real one. But look, the institutions aren't just betting on simple supply and demand mechanics. They're smarter than that. They're betting on a catalyst.
They see something on the horizon.
They see something on the horizon that the retail trader is ignoring because they're too focused on the 15-minute chart and the pain of the last 2 weeks.
And that catalyst, that big event, it seems to be sitting in a pile of paperwork in Washington, D.C.
It's always Washington, isn't it? It always comes back to the regulators. We are talking about the Digital Asset Market Clarity Act, or, the Clarity Act.
Okay, so catch us up. This bill, it feels like we've been talking about it forever. It passed the House way back in July of 2025.
A lifetime ago in this market.
So why is it gathering dust in the Senate Banking Committee? Is this just standard government incompetence, or is there something specific holding it up?
It's gridlock, but it's a very specific and very powerful kind of gridlock. It touches the third rail of American finance, the bank's profit margins.
Okay.
There's a specific poison pill in the draft legislation that has caused a complete stalemate between the crypto lobby and the banking lobby. It's all about a single provision. The stablecoin reward provision.
Okay, in simple terms, for those who haven't been following the legislative nitty-gritty, what does this provision do?
It makes it effectively illegal for a crypto platform like a Coinbase or a Kraken or even a neobank that holds crypto to offer you interest or yield on your stablecoins.
So if I have, say, $10,000 in RLUSD Ripple's new stablecoin or in USDC, and the market rate is 5%, this law says the platform can't give me that 5%.
Correct. You get zero. The banking lobby wrote that provision. And you have to understand why. It's not because they're trying to protect you from some imaginary risk. It's because they are terrified of something called deposit flight.
Explain that. Why are they so scared of me getting 5% on my digital dollar?
Think about your own bank account. Right now, if you put your money in a traditional savings account at a major bank like Chase or Wells Fargo, what kind of interest rate are you getting?
Nothing. It's basically zero. Maybe 0.05% if I'm lucky. I think I pay them more in fees than I earn in interest.
Exactly. But the risk-free rate in the economy, what the government pays on its own bonds, is much, much higher. A stablecoin issuer can take your dollars, buy short-term government bonds that are yielding 4% or 5%, and pass almost all of that yield directly back to you.
So I could earn a real return, a safe return, just for holding digital dollars.
Yes. And if you could do that safely and easily, why on earth would you keep your money at the bank earning zero?
I wouldn't. Not a chance. I'd move it in a heartbeat, the second I could.
And that is the absolute nightmare scenario for Wall Street. Standard Chartered, of all places, released a research report on this. They estimated that if this yield ban isn't put in place, traditional banks could lose $500 billion in deposits by 2028.
$500 billion. That's $500 billion just walking out the door of the banking system.
And you have to remember, banks run on fractional reserves. They need your deposits. That's their raw material. They use that money to lend out to people buying homes, to small businesses starting up, to the agricultural sector.
It's the lifeblood of their lending operations.
If they lose those deposits, their ability to lend evaporates. Their entire business model starts to crumble. So they view this as an existential threat. So they are lobbying the Senate like crazy to ban those rewards to protect their cheap source of capital.
That makes perfect sense from their perspective. They're fighting for their lives. And on the flip side, The crypto industry must absolutely hate this.
Oh, they despise it.
Yeah.
They view it as blatantly anti-competitive. It's essentially the big banks using the power of the government to mandate that you have to keep your money in their low-yield accounts.
It's protectionism.
It is. Coinbase actually withdrew their support for the entire bill because of this provision.
Oh.
Their official statement was something like, "We'd rather have no bill than a bad bill."
Wow. That is a bold move. Usually these industries are desperate for any kind of regulatory clarity, even if it's not perfect.
It just shows you how high the stakes are on this one issue.
Yeah.
But despite this standoff, there is optimism in some corners. Brad Garlinghouse, the CEO of Ripple, has been making the rounds in Washington.
And he's usually pretty plugged in. He has a good read on the political tea leaves. What's his take?
He's surprisingly optimistic, actually. On a recent interview, he gave it an 80% chance of being signed by the end of April 2026.
80% by April. That's right around the corner. That's in 2 months. Why is he so confident when there's this huge fight going on?
His argument is that, at the end of the day, clarity is better than chaos. He's urging the rest of the crypto industry to accept an imperfect bill just to get the rules of the road established.
Yeah.
And politically, there is a lot of pressure to get this done.
From who?
The Treasury Secretary has publicly criticized the recalcitrant actors who are blocking the bill, and President Trump has signaled that he wants this done. He sees it as a win for the economy, a way to show that the U.S. is leading in financial innovation.
So the political will is there to push it over the finish line, even with the lobbying?
That seems to be the bet Garlinghouse is making.
So let's play this out. Let's assume it passes. Let's assume Garlinghouse is right and it gets signed in April. Why does this matter specifically for XRP? Why is this the trigger for the institutional moon mission?
Because of one specific definition buried deep in the text of the Act. It finally, once and for all, draws the line in the sand between the SEC and the CFTC. It clearly defines what a digital commodity is.
And under that definition, XRP would be a commodity, not a security.
Under this framework, yes. It would be treated like gold or oil or wheat. That would solidify XRP's legal status, removing that last lingering cloud of is it a security that has hung over the asset for years.
Even after the court case.
Even after the court case. A court ruling is one thing, a law passed by Congress is another. This is the final green light that the really big, really conservative pension funds have been waiting for.
Because right now, a pension fund compliance officer isn't going to sign off on allocating to an asset that is illegal, maybe?
Exactly. You don't gamble with teachers' pension money. You need certainty. But if the United States Congress says this is a commodity, then the compliance officer looks at it and says, okay, we can allocate. It fits in our commodities bucket. It changes the risk profile entirely.
So, okay, we have the institutional buying happening now. We have the potential for a massive legislative unlock. But let's pivot to the actual use of this technology. Because for years, the big knock on XRP was nobody actually uses it.
The classic bear argument. It's a solution looking for a problem.
Right. Is that still true? Or is that narrative becoming harder and harder to sustain?
It's becoming very difficult to sustain.
Yeah.
We are seeing a fundamental shift in the market from pilots, companies testing things out in a little sandbox environment, to actual live production use cases.
Give me an example. What is happening in the real world right now that proves that?
Well, the biggest piece of news on this front recently is the partnership between Ripple and Aviva investors.
Aviva, I know that name. They're massive, right? They're not a crypto company.
They are giant in traditional finance. We are talking about a UK-based insurance and asset management firm with $345 billion in assets under management.
Okay, so this isn't some small startup in a garage trying to make a name for itself. This is the establishment.
This is the heart of the establishment. And they aren't just testing the XRP ledger. They are actively using it in production to tokenize traditional fund structures.
Tokenized fund structures. Okay, you have to break that down for me. Why would Aviva, a $345 billion traditional finance giant, care about putting a mutual fund or a bond fund on a blockchain? What problem does that actually solve for them?
It solves for speed, costs, and compliance, the holy trinity of modern finance.
Okay, let's take them one by one. Speed.
Right now, if you buy or sell a traditional fund, settling that trade can take days. It's called T+2 settlement. You execute the trade today, but The money and the ownership don't actually swap hands for 2 full business days.
Which means your capital is just tied up, sitting in limbo.
Exactly. It's
Yeah.
dead capital. It's inefficient. And there's a mountain of paperwork, a whole chain of middlemen, a ton of reconciliation costs. By using the XRP ledger, Aviva can settle these same transactions in 3 to 5 seconds.
From 2 days down to 3 seconds?
Think about the efficiency gain from that, the capital that frees up. And it does it at a tiny fraction of the cost. But the real selling point for them is the compliance.
How so?
The XRPL has built-in compliance features like permission domains and clawback functions. It allows a regulated entity like Aviva to know exactly who they are dealing with on the other side of the trade. All the know your customer, the AML checks, it's all embedded right into the ledger. That is non-negotiable for a firm like that.
So this is the ultimate validation. It proves the network is real enterprise-grade infrastructure. It's not just a crypto casino for speculation.
Precisely. It's plumbing. It's boring, reliable, high-speed plumbing for high-value finance.
But you have to be balanced here. We can't just drink the Kool-Aid. There is a strong bear case regarding utility that we need to discuss.
We do, and it's a valid concern that has been around for a long time.
I was reading this analysis from the Motley Fool just the other day, and they brought up the messaging versus token problem. This has been the ghost in the machine for XRP for years.
It has.
Is this the idea that banks can use Ripple's software without ever having to touch the XRP coin itself?
Exactly. Banks can use Ripple's software suite, RippleNet, for secure messaging. Think of it like a faster, better, cheaper version of the old SWIFT system. It lets them send messages back and forth saying, hey, I'm sending you $1 million. But the actual $1 million can still move through the traditional correspondent banking channels.
So they don't have to buy or sell a single XRP token to use the software.
Correct. So in that scenario, Ripple the company succeeds wildly. Ripple the software becomes the new global standard for financial messaging. But XRP the token, it just sits on the sidelines gathering dust.
That's the fear. That's the ultimate bear case. The argument is that the one product that does use XRP on-demand liquidity, or ODL, is mostly being used by smaller fintechs and remittance firms, not the big tier 1 banks like JP Morgan or Citi.
That has historically been true, yes.
And even if a big bank does use ODL, explain the velocity problem. This is a key point.
Right, so let's say a bank in the U.S. needs to send money to Mexico using ODL. They take U.S. dollars, they buy XRP on an exchange, they send the XRP instantly across the border, and then they immediately sell it for Mexican pesos on the other side. The whole transaction takes 3 seconds.
They don't hold the XRP. They don't store it as an asset.
They hold it for literally 3 seconds. It's a pass-through mechanism, a temporary bridge. So even if the ODL volume is huge, billions and billions of dollars a day, the buying pressure from one side is immediately matched by selling pressure on the other side. The asset isn't being stored, it's being used like a hot potato.
That makes sense. So high volume doesn't necessarily create sustained upward price pressure if nobody is actually holding on to the asset.
Correct. And then there's the new kid on the block, which complicates this even further, RLUSD.
Ripple's own stablecoin.
Yes. Ripple has launched its own USD-backed stablecoin. And there's a theory out there, a pretty compelling one, called the cannibalization theory.
That sounds...
It poses the question, could RLUSD end up replacing XRP? Think about it. If banks prefer stability, and we know they do, why would they use a volatile asset like XRP as a bridge when they could just use a stable digital dollar?
Right. If I'm sending money to you and we both accept dollars, I'll just send you RLUSD. I don't need to bridge through XRP at all.
It's a fair question. If I'm a bank's chief financial officer, I hate volatility. It's a risk I have to manage. A stablecoin seems much safer and more predictable.
That's the bear argument. But what's the counter argument? What's the bull case for XRP in a world with RLUSD?
The counter argument, and this is the one Ripple themselves push very heavily, is that RLUSD is a complement to XRP, not a replacement.
How does that work? How do they play nice together in the same ecosystem?
Because you still need a neutral liquid bridge asset for cross-currency swaps. It's one thing to send dollars to dollars, but what if you're trying to move money from, say, a Philippine peso stablecoin to a euro stablecoin?
Okay.
You can't just swap those two directly very easily. There isn't enough liquidity in the market for that specific trading pair. You'd get killed on the spread. You need a highly liquid middleman.
You need a bridge.
You need a liquid bridge in the middle. XRP is designed to be that bridge. The transaction would be peso stablecoin minus XRP euro stablecoin. It's the universal translator between all these different currencies. So the argument is that RLUSD just brings more liquidity and more activity onto the ledger generally, which makes the whole ecosystem deeper and more attractive for everyone.
So it's like adding more lanes to the highway. It
Mm,
doesn't replace the cars. It just lets more traffic flow through the system more efficiently.
that's a great analogy.
Yeah.
And we are seeing adoption. RLUSD is already integrated on major exchanges, and it's seeing real demand in Asia,
Mm.
specifically those Japan and Korea corridors. It seems to be creating a more robust ecosystem, not a smaller one.
Okay, so we have the utility debate. It's a complex picture. But let's talk about the rumor that just refuses to die. The big one, the BlackRock factor.
Ah, yes. The rumor that creates a 10% pump in the price every other week.
Is there any truth to this? I mean, are we really going to get a BlackRock XRP ETF?
Yeah.
Because that feels like the ultimate God candle event for this community.
Well, officially, there's no filing yet. You can go to the SEC website right now. There is no S1 application from BlackRock for a spot XRP ETF.
So it's just speculation.
It's speculation, but it isn't coming from nowhere.
Hmm.
You have credible experts in this space, people like Stephen McClurg, who is the CEO of Canary Capital, and he is out there predicting it.
What's his timeline? What's he saying?
He's looking at late 2026 or early 2027.
That feels like a lifetime away in crypto years.
Yeah.
Wait, if they're going to do it, why not just file the paperwork now?
Because that's not how BlackRock operates. BlackRock doesn't gamble. They don't file ETFs hoping they get approved. They do all the work behind the scenes, and they file when they know they will get approved, and more importantly, when they know the market is ready for it.
They need a deep pool to swim in. They're too big to just jump into a small market.
Exactly. They wait for the institutional demand to be undeniable, and they wait for the liquidity in the underlying market to be deep enough to support their massive size. They need the commercial case to be absolutely bulletproof.
And with XRP's market cap now over $113 billion and the regulatory clarity we discussed coming with the Clarity Act.
The case is becoming undeniable. It's checking all their boxes.
And if BlackRock files, what does that actually mean?
If BlackRock files, it changes the game instantly. And it's not just about the ETF itself. It's about Aladdin.
Aladdin, like the Disney movie.
No, not the movie.
Yeah.
Aladdin is BlackRock's internal risk management and portfolio operating system. It is the single most powerful piece of software in finance.
I've heard of this. It's huge.
It is the platform that manages risk and assets for almost every major bank, insurer, and pension fund in the world. We are talking about an estimated $40 trillion in assets that are managed or monitored through that one system.
Trillion with a T. It's hard to even comprehend that number.
If XRP gets integrated into the Aladdin platform, either through an ETF or a tokenized fund, it suddenly becomes a one-click purchase for every single major asset manager on the planet. It opens the floodgates for global distribution. That is the real BlackRock factor.
That would be the ultimate stamp of institutional approval. But right now, we are still in the trenches. You mentioned a whale war happening on-chain earlier. Let's look at the actual battlefield. Who is winning right now?
It's a fascinating struggle to watch in real time. We have on-chain data showing that wallets holding between 10 million and 1 billion XRP, these are the big whales, they sold off approximately 50 million tokens during that recent rally attempt to $1.67.
Okay, so the big money, the whales, were taking some profit off the table.
Some of them were. They were selling into that brief moment of strength. But here is the kicker. Long-term holders, the true believers, the HO dealers, the accounts that rarely sell, they absorbed all of that supply. They increased their positions by 17% during that same period.
So the whales sold 50 million tokens, and the long-term holders stepped in and said, thank you very much, I'll take that.
Exactly. And at the same time, the rich list is growing.
The rich list? What's that?
It's the number of wallets that hold more than $1 million worth of XRP. That number has increased by 42 since January 1st of this year.
That might not sound like a huge number, 42 wallets, but to become a new crypto millionaire betting on this one asset, that's significant capital.
It is. Think about what that requires at today's prices.
Yeah.
You have to buy nearly 700,000 XRP to get on that list. That is high conviction buying. The top 0.01% of holders are accumulating. They were squeezing out the retail investors who were panic selling at the bottom. It's a quiet consolidation of power.
And going back to that liquidity lock idea, what's happening with the reserves on major exchanges like Binance?
They are draining. The
Okay.
data is undeniable. The XRP reserves sitting on Binance have dropped by 700 million coins over the last 15 months.
700 million. And where are they going?
They're leaving the exchange and going into private wallets or into institutional cold storage.
Which means they aren't for sale anymore. They're not part of the actively traded supply.
Correct. The available supply for trading is getting thinner and thinner every single day. If you're a large fund and you want to buy 10 million XRP right now, You are having a much harder time finding a seller without moving the price than you did a year ago.
So, okay, we have shrinking supply, we have growing institutional demand, we have potential legal clarity on the horizon, but the price is still stuck in the mud. So where do we go from here? Let's talk price predictions, because at the end of the day, that's what everyone wants to know. When moon?
The short term is,
Uh-huh.
it's tricky. We're still in the thick of the February curse, and the charts are messy.
Time for some technical analysis. What are the lines on the chart telling us?
Well, there are conflicting signals, which
Hmm.
is typical for a market at a crossroads. On one hand, XRP is in what's called a rising wedge pattern on the daily chart.
And is that a good thing or a bad thing?
Generally, a rising wedge is a bearish signal. It means the price highs are getting higher, but the lows are getting higher even faster. The price is getting squeezed into a tight corner. Usually that pattern resolves with a sharp break to the downside.
Okay, not what people want to hear.
No. However, technical analysis is all about probabilities, not certainties. There is also a very clear fair value gap on the weekly charts that is acting like a magnet, and it targets $1.80.
Explain a fair value gap for us.
It's basically a hole or an inefficiency in the chart where the price moved up or down too fast, leaving an imbalance behind. The market has a memory, and it tends to want to go back and fill that gap to rebalance the order book. That gap is sitting right at $1.80.
So we have a bearish pattern fighting against a bullish magnet.
Exactly. It's a tug of war.
What are the critical levels we need to watch? If I'm just watching the chart on my phone, what are the numbers that really matter?
On the downside, the absolute line in the sand is $1.26. That level represents the cost basis for millions and millions of coins. It's a huge psychological support level. If we break and close below $1.26, a quick drop to the $1 mark is very, very possible.
And what about on the upside? What's the breakout level?
We need to decisively break and hold above $1.53 and then clear the recent high of $1.67. If we can clear those two hurdles, we invalidate that bearish wedge pattern, and it likely triggers a powerful rally right up towards that $1.80 cap.
I know a lot of people use AI models now to predict these things. They ask ChatGPT, what are the robots saying?
It's mixed, just like the humans. ChatGPT seems to be pretty bullish. It sees a higher floor establishing for the asset, and it's predicting a range between $2.10 and $2.60 in the coming months.
Okay, that's optimistic.
But then you have Grok, which is more cautious. It's warning of more consolidation, saying the price is likely to be stuck between the $1.25 and $1.45 for a while longer.
So even the AI can't agree. What about the big banks, the human analysts? What are they saying for the long term, say end of 2026?
Standard Chartered has famously updated their forecast. They used to have a very aggressive $8 price target for XRP.
Right, I remember that report. $8 would be life-changing money for a lot of people. That's almost a 6x from where we are today.
They've slashed that. They've walked it back significantly. Their new target for year-end is $2.80.
Wow. That's a big, big cut from $8 down to $2.80. Why the downgrade?
Their reasoning is that the overall market recovery has been slower than they expected. The February curse hitting so hard, combined with the legislative delays with the Clarity Act, has pushed their timeline back. They still see significant growth, just not the explosive parabolic growth they were predicting 6 months ago.
But is the $8 dream dead? Is that Super Bowl case completely off the table now?
Not necessarily. It's a lower probability now, but there is still a valid mathematical path to get to those higher numbers, like $8.
What would it take?
It all comes down to a supply shock, a massive one. If these ETF inflows continue at their current pace, if we see, say, $10 billion in net annual inflows into the spot ETFs, that would require the ETF custodians to go out and buy between 4 and 5 billion XRP tokens from the open market.
And with the exchange reserves already at a 7-year low.
Exactly. If there are only 1.6 billion tokens available on all exchanges, and the ETFs need to buy 4 billion, where do those tokens come from?
The price has to go vertical. It has to go up until it finds someone, somewhere, who is willing to sell their long-held coins.
Bingo. It's simple, brutal economics. Extremely low supply, extremely high demand. The price has to go vertical to find equilibrium. In that specific supply shock scenario, a price of $4 to $8 is still on the table.
But we also have to acknowledge the bear case. We have to be responsible and talk about what could go wrong.
You do. There's no guarantee here. If the Clarity Act fails, if the banking lobby wins and they manage to kill the bill for good, or if that cannibalization theory proves true, and RLUSD ends up eating XRP's lunch and the big banks stop using the token entirely.
Then what?
Then the price could stagnate for years. We could see a slow bleed back down to the pre-2025 levels, maybe even under $1.
It really feels like a binary outcome.
Yeah.
It's either going to succeed on a massive scale or it's going to be a ghost town. There's no middle ground.
That is often the case with truly transformative, disruptive technology. The middle ground is a very rare place to land.
So let's wrap this up and recap. What are the big key takeaways for our listeners today after this deep dive?
First, and most importantly, you have to recognize the disconnect. Retail is scared and selling out of fear. The institutions are greedy and buying record amounts via the ETFs. Don't let your short-term emotions dictate your long-term strategy.
Okay, number one, watch the flows, not the feelings. What's number two?
Number two, watch Washington. The Clarity Act is the single biggest bottleneck right now. If that logjam clears in the next couple of months, the institutional floodgates could truly open. The utility is shifting and expanding. It's not just about cross-border payments anymore. With major players like Aviva coming in, it's about the tokenization of the entire financial system. It's a much, much bigger game now than it was 5 years ago.
It's a lot to digest, a lot of moving parts. But before we let you go, you always have a final, provocative thought for us. Something to chew on, something to keep us up at night.
I do.
Right.
And tonight, I want you to really, truly think about that concept we discussed earlier, the liquidity lock.
Okay. The ETFs taking supply off the market.
Yes. Institutions are methodically buying up 1% of the available supply every single month. Retail investors are, in aggregate, selling to them. We are watching the public float of this asset disappear from public exchanges and move into private corporate hands.
Right.
So I want you to ask yourself, at what point does the public float of XRP effectively vanish?
You mean, what happens when there are literally no tokens left on Binance or Coinbase for an average person to buy?
Exactly.
Yeah.
We might be witnessing the slow-motion privatization of a public crypto asset right before our eyes. If the institutions end up owning it all, and they aren't selling because they're holding it on their balance sheets for 10-year time horizons, what happens to the price then?
It becomes a name your price market. There is no market price anymore.
Exactly. It becomes a scarce digital commodity that you can't just buy on an app anymore. You have to be invited to participate in that market. And that is both a terrifying and incredibly exciting thought.
The privatization of XRP, that's
Yeah.
heavy. Well, on that note, we are going to wrap it up. As always, stay curious, look beyond the headlines, and please don't let the fear and greed index run your life.
And remember, none of this is financial advice.
Yeah.
Always do your own research.
Thanks for diving deep with us. We'll see you next time.
See you then.